This first lecture in Healthcare Finance 1 is going to cover financial accounting basics, and we're going to cover the first two financial statements that we will go over in this class. Income statement and the statement of changes in equity. This video corresponds with Chapter 3. As previously mentioned in class, financial accounting involves identifying, recording, and communicating the organizational results and the status of an organization. Financial accounting information is conveyed by financial statements. There are four that we will focus on: the income statement, statement of change in equity, balance sheet, and statement of cash flows. The financial statements I just mentioned are prepared using accounting rules called Generally Accepted Accounting Principles, or the GAAP. These rules are necessary in order for stakeholders, investors, to be able to compare among companies and across time. Within the United States, the Financial Accounting Standards Board, or FASB, has the primary responsibility for developing accounting principles. The FASB publishes statements of financial accounting standards as well as interpretations of these statements. Many countries outside of the U.S. use generally accepted accounting principles adopted by the International Financial Reporting Standards Board, or IASB. Currently, the FASB and the IASB are working together to reduce and eliminate deficiencies and develop a single set of accounting principles that will apply across all countries, including the United States. Here are a few of the accounting concepts that fall underneath the GAAP for financial reporting. The first one, accounting entity, specifies that an organization needs to indicate the accounting entity or the organization's name on their financial statements. While this may be common sense, it is necessary because many organizations have multiple subsidiaries. Think of Johnson & Johnson. So you may have individual financial statements for each of those entities, or as is usually published in their annual report, it's a consolidated financial statement for the entire organization. So on the financial statements, you specify the accounting entity. Conservatism is the next one, and based on this concept, it is better to be conservative in the estimates than to overstate the financial condition of a company. So if you're making projections and any of that information is on the financial statements, they are to be from a conservative basis. And given the things that have happened on with some of the organizations today, such as Enron and what's going on Wall Street, this just gives you an example of why it is so important. Next, we have the going concern. This assumes that the organization has an indefinite life, and therefore you will value all of its assets on the basis of the value to the business for continuing the operation, not just on what it would be if it was liquidated on the market. Consistency and comparability. This concept indicates that it is important to be able to apply like guidelines to a single accounting entity over time as much as possible. And the purpose for this is so that you can compare statements and look for trends. So an organization should apply the same accounting principles in one fiscal year as they apply to the next, unless there's a major reason for them to change. The concepts of relevancy and materiality discuss the importance of the information being relevant to the users that are going to be looking at it, and include sufficient information for them to base their decisions. This does affect the presentation of the financial statements in terms of the categories that are used. While there are standard categories you see on most financial statements, some organizations do indicate even additional categories based upon the industry they're in. In other words, they can break them into greater detail. For example, breaking the inventories out in a retail business versus in a service business where labor is more intensive in a service business than inventories. The next concept is objectivity and reliability. And this is based on the necessity for the information to be objective and verifiable and have supporting data. Reliable as in error-free, and it can be reproduced with the same results from the backup data in case it were to be audited. Monetary unit. On the financial statements, it is important to specify the monetary unit of the values placed in them. In the U.S., our monetary unit is the dollar. However, many of these organizations work across international boundaries and have a variety of monetary units, and they must take into consideration the exchange rates and inflation across time and comparing it against different years when they're doing their financial statements. The full disclosure concept indicates that a corporation should contain in their financial statements a complete picture of the economic events of that business. Nothing should be intentionally left out that could sway or bias investors. And finally, we have the accounting period. Financial statements need to define the period that the data applies to. Typically, you see accounting periods either on a quarterly basis or they're reported once a year on an annual basis. However, financial statements could be at a more frequent reporting period. That's why it's important to specify at the top of the financial statement what the accounting period is. Next, I'll give an overview of the 4 financial statements we'll be looking at: income statement, retained earnings statement, balance sheet, and statement of cash flows. Then we'll go into more depth in the first 2. So let's take a look at some examples from Christus Health System. And as you see on here, this is a consolidated statement which indicates multiple entities are included. So we would want to look and see which facilities they had included. And they are presenting the data for 2008 and 2009. And what we are looking at is the statement of operations, also known as the income statement. You will see those terms used interchangeably. It starts with revenues, followed by expenses. Then, as you can see, they had an operating loss. Here's an example of the changes in net assets. You tend to see this term used for non-profits. For for-profits, you'll see either the retained earnings statement or changes in equity statement. Here is Christus Health's statement of cash flows, and we will be looking at this in our next lesson. But as you see, it breaks it down. There's 3 categories: operating activities, investing activities, and financing activities. Finally, we have the balance sheet. The first portion is the assets listed, with current assets first and then long-term assets following that. The second part of the balance sheet lists the liabilities and net assets. And for profits, you would see this listed as liabilities and equity. Let's take a closer look at the income statements. Perhaps the most important question about a business financial statement is whether or not it's making money. The income statement provides information about a business's operations and its economic profitability. As mentioned previously, the income statement is often called by other names: statement of operations, statement of activities, or income statement. The income statement has 3 key components: revenues, which is the result of sales of products or services; expenses, which are the resources that are expended in order to produce those revenues; and then the difference between the revenue and expenses known as net income, or profit or loss. On not-for-profit financial statements, you'll tend to see the term revenue over expenses used in place of net income or profit. We will discuss the accounting concept of accrual and cash accounting later on in this lesson. Revenues are shown in several different formats depending on the type of provider. Sunnyvale, the example we'll look at next, has two revenue categories. Under patient services revenue, which is primary source of revenue in a health facility, you can see it listed as gross patient services revenue or net patient services revenue. Gross is the full charge, whereas net is less than the gross charges. In other words, it is net of the discounts that are offered, charity care, or bad debt losses. Bad debt generally gets listed as an expense separately. While not always listed separately, coinsurance is the portion of patient services revenue that is paid by the patient as opposed to the insurance company. And premiums earned is revenue that comes from capitated plans. As you recall, we discussed how capitated plans charge a per member per month fee for those patients in that plan. Often you'll see patient revenue just listed as fees, particularly in an outpatient setting. Health facilities can also earn interest and other income from their investments or from other activities that they have in their facility. Think of a hospital. Generally there are fees for parking, charges that come from a cafeteria, and flower shops. Revenue is earned from those as well, and you find those in the facility. The total revenue line summarizes the total different types of revenue that has been earned. Do note, though, that frequently other revenue is broken out separately from the primary source of revenue, which would be patient services, on the income statement. Here we see an example of the income statement for Sunnyvale Clinic. Note that the figures presented are in the thousands. At the top of the income statement are the revenues listed: net patient services revenue and other revenue. Those are added together to obtain the total revenues. On the expense line, you see several different types of expenses. Let's go over some of those. Salaries and benefit expense represents labor cost. Typically, this is the largest expense category for health service organizations. Supply expense represents the cost of expendable, primarily medical, materials. The dollar amount shown represents the amount consumed, not the amount purchased. Supply stocks are reported on the balance sheet. Next, we have insurance expense. Insurance expense represents the cost of commercial insurance purchased to protect the clinic against several risks, including property risks such as fire or weather damage, and liability risk such as medical liability. Sunnyvale owns most of its land and buildings, but it leases much of its diagnostic equipment. Lease expenses report the cost of its leases. On the balance sheet, some leased assets are reported directly, while others appear only in the footnotes of the balance sheet. Regardless of the balance sheet treatment, all lease expenses are reported on the income statement. Next, let's talk about depreciation. While operating costs such as labor and supplies are assumed to produce immediate revenues and hence are more or less immediately reported or expensed on the income statement, the costs of long-lived assets such as buildings and equipment are not reported on the income statement at the time the acquisition is made. Rather, the cost of long-lived assets is first capitalized, that is, recorded on the balance sheet as an asset of the business. Then this amount is amortized or spread over the accounting life of the asset, which means the cost is shown or expensed on the income statement as small increments over time. The amortization expense of buildings and equipment when listed on the income statement is called depreciation. For financial accounting purposes, depreciation is calculated by the straight line method, which we will discuss further. Provisions for bad debt expense reports the amount of net patient service revenue that is not expected to be collected. It is an estimate based on past experience of patients who are able to pay their bill not paying it. Past estimates are reconciled when the data are known. Interest expense reports the amount of interest paid on debt that the organization has financed. As you can see, the total expenses are summarized. Finally, we have the net income, which is the difference between the revenues and expenses. Sunnyvale Clinic has less net income in 2007 than they produced in 2006. Next, we'll talk about the difference between for-profit and not-for-profit businesses' income statements. The income statements of for-profit and not-for-profit businesses are very similar. The revenues and costs of the organization in the same type of business are similar regardless of the ownership. And when we talk about ownership, it can be investor-owned, proprietorship, etc. However, some transactions, such as income tax payments, are clearly applicable only to for-profit businesses. Actually, the line of business or the type of business differences are greater than ownership differences. Here is an example of a non-profit income statement, Family Healthcare. The income statement shows fees earned of $5,500 and total expenses of $2,900 for a net income of $2,600. Operating expenses are normally listed in order of size, beginning with the largest expense. However, miscellaneous expense is usually shown as the last expense item, regardless of the amount. Here's an example of a for-profit income statement. Can you see what the difference is? Here there's an extra line or two. The difference between fees earned and the total operating expenses is the operating income. Taxes are applied to the operating income and deducted from it to get the net income. So in this case, you have an operating income of $2,600, and at a 35% tax rate, the provision for income taxes is $910. That is deducted from the operating income to get the final net income of $1,690. Next, we'll look at the statement of changes in equity, also known as retained earnings statement for-profits. In a not-for-profit organization, the term used is statement of changes in net assets. This particular statement represents the amount of profit that is retained in the organization over time, and it is reduced by dividends that are paid out to stockholders in for-profit organizations. Here is an example of Sunnyvale Clinic as a not-for-profit organization, their statement of changes in net assets. You'll notice that they have the beginning balance at the beginning of the year in their net assets of $46,208 in 2011. This represents their accumulated assets in the organization. In 2011, they earned a net income of $7,860. That increases their total net assets, as noted at the end of the year, to $54,068. You'll notice that net assets at the end of the year of 2010 is the beginning balance for the net assets of 2011. This will become clearer as we take a closer look at the balance sheets later. Here is Sunnyvale Clinic as a for-profit. You'll notice the title, Statement of Changes in Equity. The primary difference is that dividends are paid out in for-profit organizations to stockholders, and thus it reduces the retained earnings. Here you see the net income listed on the first line, and net income is the amount after taxes have been taken out. The dividends are paid with after-tax dollars. In 2011, the dividends were $2,000, which reduced their equity by that amount. The total increase in equity for 2011 was $58.60. They had a beginning of the year balance of equity of $44,308. Notice it's the ending balance for the year of 2010. The increase of $58.60 throughout 2011 results in an end of the year equity of $50,168. Now, let's test your memory.